Bloomberg Audio Studios.
Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, we are here on the West Coast. Right now, we're in Newport Beach. It's so nice.
I love it down here so much. I look. This is probably might be tied. Yes. I will look for any excuse to come down to this part of the country.
We can just listen to Joe wax lyrical about California, but we are here for work.
Yes.
In theory. We're here for the Future Proof Conference, which I think, honestly, all financial conferences should be like this. They should all take place on a beach with food trucks, and we should just hang out outside and talk to each other about markets.
Sounds good. But we're not on the beach right now.
No, we are not. We are actually, well, let me just say, no trip to the West Coast would be complete in terms of an Odd Lots episode without hitting up Pimco stopping by.
That's right. The icon of Southern California investing in markets.
And what a great time to be doing it because, of course, we're recording this on Monday. And on Wednesday, we have the big Fed decision.
That's right. It's huge. Almost virtually locked that we're going to see the start of the rate cut cycle. But there's still a lot of debate about 25 or 50, what they signal for the rest of the year, how significant is it, whether they choose one or the other. Definitely one of the most exciting, anticipated ones in years. And as of the time that we're recording this on Monday morning, there is still significant ambiguity. And who knows, by the time you're listening to this, maybe there will be some leak in the media and everyone will have settled on 50 or 25 or something. But at least as of right now, we don't really know what's going to happen.
You mentioned ambiguity, and this is really the remarkable thing about this moment in time, which is everyone figures they're going to cut, but we don't know 25 or 50 bips. And the crazy thing is, if you look at the swaps market right now, we're basically evenly
Coin
split.
Flip, yeah.
Yeah.
True excitement.
Yes. All right. So without further ado, I'm just going to emphasize we do, in fact, have the perfect guest to be talking about all of this. We're going to be speaking with Dan Ivascyn. He is, of course, the Pimco Group CIO and a managing director here in Newport. Dan, thank you so much for coming back on All Thoughts.
Thanks. It's really exciting to do this and do it in person this time.
Yeah, absolutely. And perfect timing, really. So I'm just going to jump into the big question.
The big question.
25 or 50, what will it be?
Sure. Well, let me, real fast. I don't think it'll matter that much unless you're betting on that front-end contract. And we think it's going to be a close call. The guess based on the news flow this weekend is they may actually go 50. But I think the key point will be that this will either be a very dovish 25 basis point cut or a more balanced 50 basis point cut. We think the Fed wants to get rates down. They believe they're in restrictive territory. And I think the key point is this is the beginning of a cutting cycle, and we haven't had one in quite some time.
I've heard people say that if they go 25, that they could do it in a dovish way and perhaps signal via the dots that there will be more aggressive rate cuts through the rest of the year to balance that out. And that the question then would arise, well, if you're already saying that, why not just go 50? Just from your perspective, how does the Fed think through this question? Maybe it doesn't matter that much. And, in the long sweep of history, maybe it doesn't. But how do you think the Fed is thinking through these options?
Yeah, well, I think the first point to note is that the market's already done a lot of work for the Fed. You've seen the pricing of some pretty significant cuts going into year end. Mm-hmm. In fact, we now have well over 100 basis points of cuts priced in and another, 125 to 150, the following year. So, a combination of the data and some statements by Fed officials thus far has already eased conditions. And I think what the Fed is concerned with is the fact that inflation isn't yet at target. We've made some progress, but every time they speak in a dovish tone, you see stocks do pretty well, and credit spreads are near very, very tight levels or near the tights of this cycle. So they're going to be walking a tightrope a bit in trying to ease conditions without easing too much, without letting the markets get ahead of them, and without letting some of these positive wealth effects, potentially drive inflation higher. And again, through the combination of action, signaling via the dots, and the tone at the press conference and future correspondence with markets, they likely have enough tools at their disposal where even if they get something wrong in a narrow sense, that they can course correct to get the market back on track as necessary.
You mentioned tone of the meeting, and one of the arguments that has come up recently is this idea of, well, maybe they don't do 50 bips because they don't want to make everyone really worried that the economy is significantly slowing down. Do you worry about like that side of the messaging at all? Is there the possibility that they go 50 and everyone's like, oh, it's worse than we thought?
It's possible. I think the other mistake, though, or concern I should say, is that by going 50, the market gets further in front of them in terms of expectations for even more aggressive policy. So I think both risks are there. Again, I think perhaps some of these concerns about the Fed being behind the curve or, too in front of the curve relative to where inflation is, I think they're interesting sound bites, but I and we do think that the Fed has enough tools to be able to navigate the next several months. I think the key for markets, though, is to really, really listen to what the Fed is saying. They are going to be looking at the data. Therefore, as market participants, we want to focus on the data. The data is ultimately going to be driving these outcomes. And I think it's a really interesting period for markets, given that the data has been volatile. And we think it will likely continue to be quite volatile, creating ongoing uncertainty.
So setting aside whether they do 25 or 50 this week, the other big question is sort of, I guess, maybe more medium term or long term, but has the neutral rate or the long term neutral rate of interest gone up since pre-COVID? And there continues to be a lot of discussion about this. No one really knows. Do you think there's been some sort of structural change in the economy over, I guess, basically the last 4.5 to 5 years now, such that the neutral rate of interest is higher? And what has changed, if so?
So we think it may be a bit higher. But if you look back through economic history, these neutral policy rates, or this concept of an R star, is important, but it doesn't tend to move that quickly. And I think a lot of the research, including our own, and we dusted off a lot of older research and updated these studies, this summer, suggests that, R star may be a bit higher, but there's massive uncertainty around this type of research. So again, I think the bottom line, as you said, is we don't know for sure. We suspect it's a little bit higher, but not as high as some more bearish folks out there think it may be. And the reasons for that: higher debt levels, the need for significantly more physical infrastructure investment this cycle, less globalization, the desire for supply chain resiliency, we think are just a few factors contributing to the likelihood that R star is higher.
But just the implication, though, if it's only modestly higher, is at least from here, again, setting aside what they do this week, that there is substantial room for them to cut, and you'd expect their deep cuts from here.
That's correct. And, our thought process is, maybe R star is 0.5% higher, not on the order of 1.5% higher. So the bottom line is, relative to a concept of neutral, even if neutral is closer to a 3% nominal funds rate or even a little bit higher, gives them a lot of room to get policy back to what they perceive to be neutral. And again, with any cycle, you can have overshooting to the downside too from a growth and inflation perspective. So there's always a chance that into a weaker economy than they and we currently anticipate, that they have room to shift into accommodative territory as well.
What's your sense of financial conditions right now? Because you have great insight into the market. You buy mortgage bonds, you buy credit, you buy treasuries, obviously. What are you seeing in terms of the market right now? I'm thinking particularly of credit spreads. Those are still near cycle lows, basically.
Yeah, so that in aggregate, conditions still appear to be quite loose. When you look at stock markets near all-time highs, credit spreads very, very tight. From a very, very high level macro sense, there's still a lot of liquidity in the system, a lot of confidence, a lot of momentum, positive momentum, and risk asset spreads are quite tight. But we know that looking at aggregate measures can be misleading. If you're a lower income consumer that doesn't own a home, where we know U.S. households have a lot of equity trapped in their property or in their primary residence, there we are beginning to see signs of weakness. Most of the debt that those households have incurred is floating rate in nature, and they're feeling a lot of pressure. You look at the floating rate credit markets, some of the lending that's occurred to some weaker quality borrowers, to commercial real estate sector, you're seeing signs of stress there that are probably not as evident, out there in the marketplace as they should be. So there are sectors of the market that we're beginning to see deteriorate. We think that's what's on the mind of the Federal Reserve. That alongside, some of the more recent, broad labor market weakness, all suggest that the Fed, from a insurance or risk management perspective, should likely begin to get rates lower. And then again, carefully look at the data to just make sure and to calibrate, to prevent a reacceleration of inflation into even looser financial conditions.
If it's the case that R star is just a little bit higher than what it used to be, and if perhaps some in the market are overestimating how much it's risen, what areas of the market specifically are either mispriced or are the most attractive under your assumptions?
Well, good old-fashioned high-quality bonds would benefit to the extent that
We're talking high-quality corporate bonds here.
high-quality, really any type of high-quality bond. And what's nice about the high-quality bond market is that if you have a multi-year time horizon, the analysis isn't that complicated. You typically earn your yield. And then any type of incremental return you can get through thoughtful asset allocation or alpha generation is incremental return that you'll receive. To the extent that policy rates or neutral rates look very similar to where we were pre-COVID, that creates room not only to realize upon very, very attractive real and nominal yields, but for the prospects for price appreciation as well. And I think related to that point is that fixed income has historically done real well when bad things were happening elsewhere within your portfolio. When economic growth has been weak, really the 22 experience and this inflationary experience has been the exception to the rule.
Yeah.
And we do think there's a good chance, regardless of whether, neutral policy rates are a little bit higher than they were pre-COVID, that we're getting back into that type of paradigm where fixed income not only has an attractive yield, but it will have defensive, diversifying characteristics finally. And again, that takes some convincing for investors given, the battle wounds we all suffered during the 22 experience.
You mentioned the idea of fixed income sort of coming back. How are you looking at pricing on the short end at the moment? Because as you said, one of the risks is that the market kind of gets ahead of itself right now in pricing in rate cuts. And some people look at those shorter term maturities right now and think like, well, maybe it is a little bit overdone.
Yeah. So again, if you have a 3 to 5 year time horizon, this is really noise. Lock in some of these attractive high nominal or real yields and then benefit from some of the most attractive income that we've been able to generate in a very, very long time. From a tactical perspective, though, it's been very, very target rich. And in looking at the yield curve today, we do think that the markets may be getting a little bit ahead of themselves in terms of near-term cuts. Yeah, we've had some employment weakness, but then we had a CPI number recently that surprised a bit to the upside. Earlier this year, data surprised in a more concerning fashion. So we think that, over the course of the next few months, there are some risks of reaccelerating inflation, which may lead to less cuts that are priced into the market. So what we're doing currently is reducing some of our exposure to the very, very front end of the yield curve. And I'm talking about 1 or 2 year type maturities. And then our favorite part to invest in on behalf of our clients is really in the intermediate part of the curve, in those 5 year type maturities where you look at the market today and where you have a terminal federal funds rate assumption in the market today, somewhere close to 3%. We think that's reasonable. That would be consistent of higher neutral rates relative to where we were pre-COVID and allow for some price appreciation if we were to get into a more challenging macro environment. So a lot of activity, within the U.S. market, across markets, a lot of volatility in the front end of the curve. And right now we have been taking a little bit of risk off, thinking that, perhaps, over the next few months, people are a little bit optimistic about the Fed being able to get rates down as quickly as people, or at least some people anticipate.
Can I ask a process question? These are actually my favorite questions, but you manage I think it's $158 billion Pimco Income Fund. And I guess the mandate is preserve capital while generating income, which gives you the full suite of fixed income basically to look over. You could buy, longer maturity treasuries, all types of corporate bonds, mortgage-backed securities, obviously. How do these decisions land on your desk? Like when you're making these investment decisions, like what is the optionality that is actually presented to you? And then just to connect it back to the Fed, on Wednesday, the Fed decision comes out. What does your day-to-day look like on a day like that? How quickly are you cutting positioning, and what are the options available to you?
Sure. We take a long-term orientation. So a lot of what we do is about process, looking for repeatable sources of alpha or return relative to passive alternatives based on market inefficiencies, market frictions, looking to leverage that flexibility that we're afforded in a strategy like the income fund. So in that sense, it's very process-driven, and it doesn't relate to a view on the Fed or a view on the directionality of interest rates. And that tends to be a good portion of the incremental return that we generate. In addition to that, as you know, Pimco's always had a very structured investment process. We get together and we talk about 3 to 5 year themes impacting markets every summer on a quarterly basis. And we just finished this process last week. We get together talking about the outlook for markets across a 12 to 18 month period. And then we have the investment committee. So I'd categorize portfolio construction as targeting a lot of low-hanging fruit tied to market frictions and inefficiencies, and then the overlay of tactical, more macro-oriented themes as well. And those will be done through a committee process. And then when you have a volatility event like the Fed or a major data release, we stand poised to react. So, on a day where the data may be surprising the market, where there may be some overshooting, we have orders in. It could come directly from myself or other teammates on the strategy. Perhaps we're coordinating across multiple strategies as well. But over a full cycle, those types of short-term tactical moves get a lot of the press. Probably why I'm not as popular on CNBC. It's when you talk about process, long-term orientation, it's less fun. But it really is about a lot of process, and then standing by to take advantage of overshooting in markets when they really present themselves.
All right, I'm going to ask an even more specific, I guess, process type of question, but literally on Fed Day. What are you doing? Do you have the TV on and you're like chatting with people, IBing? Like, what is like your process of, what is the process of consuming and digesting and hashing out the views look like from, well, I guess you're on West Coast time, and that blows my mind. So I guess the decision comes out at 11. But what are you doing? What can we, if I close my eyes, what can I imagine is going on in your offices at that time?
Well, I remind my colleagues, and as you talk to others over time, they'll mention this. I remind people it's less important than people think it is.
I know,
Fed
but
Day,
still,
employment day.
we know, but we still, I'm glued to it, even though I know in the end, the heat death of the universe means none of it's important. But like, what are you doing?
But here's what we do, and we do it, pretty much every time. We make sure we're around for the Fed announcement. We're usually in our trading seats.
Okay, fun.
Nearly regardless of what other activities are going on that day. We immediately read the release. We have some type of wordsmithing, more quant type analysis, or of the actual words, where we get a dovish and a hawkish score just based on the readout relative to prior readouts, and then we all listen to the press conference. As soon as the press conference ends, we run into the investment committee room. We typically have our advisor, Ben Bernanke, there. Of course, we have the recent vice chair.
That's useful.
Not bad.
It is.
Not a bad advisor to have on staff.
It's good to have Ben around. And of course, Rich Clarida rejoined us, the recent vice chair as well. So, Rich will join, as well as our various Fed watchers and other macro thinkers. And we go around the table, talk about the outlook, or talk about the conclusion of the press conference, any other data that was released. And then we conclude with the question as to whether anyone did anything in response to the Fed number. Should we change portfolio positioning? As Bill Gross used to remind us, you can't trade a Fed call in the market per se. I guess you could trade, Fed funds futures.
Sure.
But it's always important to take, whatever type of macro release there is or decision that's made and translate it pretty quickly into an investment decision. Sometimes we trade a little bit. Sometimes we don't trade at all. Occasionally we'll trade a lot based on that information. And we always leave with a roadmap on what we're going to do, during the remaining trading day on that particular Fed release day, and then put together a game plan if necessary for future trading sessions as well.
Tracy, I just got to say, if they had a microphone in that room, it would be the greatest macro podcast in the history of podcasts. I really would love to hear that.
If you ever decide to do that, Dan, let us know, and we will gladly record a fly-on-the-wall episode of Odd Lots at your investment committee. Okay, but since we can't really do that, but we're talking about FOMC day. What about early August when we had the big market sell-off? What was that time period like for you? Because I imagine on the one hand, it was sort of knuckle clenching for a lot of market participants. But on the other hand, a lot of people talked about the opportunity to come in and buy stuff that was briefly on sale.
Yeah, so overnight in Japan, we did some trading. Most of the flow was really in the volatility markets and in the equity markets. So it was a little bit less of an event within fixed income, but there was a chance to take advantage of some local overshooting that occurred in the Japanese market. Then even earlier in the day, U.S. time, some ability to trade global fixed income markets and take advantage of some overshooting there. But again, given the size of the move, a lot of time spent that day just talking about potential implications for overall markets, positioning, questions around Japan. Maybe we were missing something in terms of embedded leverage over in that market. And then again, of course, things settled down relatively quickly. Again, another important point regarding that event, again, is that you had a situation where you have a little bit of weakness in the labor market data, a little bit of a surprise in the Japanese market from a policy perspective, and pretty big moves. And this time, these moves coincided with a big rally in the front of the bond market. So again, a reminder that we're getting to a point now from a valuation perspective and where we are in the macro cycle that fixed income may exhibit these types of insurance type characteristics once again. And then the second point, and probably the most important point, is that when markets are expensive, it takes less negative surprise to create bigger moves. And this is the world we're living in today. Equity valuations are stretched. There's a lot of reliance on central banks to engineer positive economic and financial market outcomes. Credit spreads are tight. And anytime you have this type of dynamic, you just have to be prepared for bouts of volatility, bouts of overshooting. And as an active asset manager, that's where we can shine by having the flexibility necessary to be buying when other people are selling somewhat indiscriminately and not getting caught up into forced sales activity ourselves.
I'm glad you brought it back around to the sort of hedging insurance role that fixed income can play in times like this. Because looking back over the last several years, one of the things that really struck me from like basically the financial crisis to COVID was just this beautiful relationship of stocks and bonds from the investor perspective, because you're getting paid by your bond holdings, stocks were going up, and then the moment you had some stock weakness, the capital appreciated. It's just like this beautiful line that went up when you combined the two. And then, as you mentioned, 2021 and 22, like that broke down, obviously, and bonds didn't provide that same ballast that went up every time when stocks went down. I'm curious if you've seen a change from a business perspective and a distribution perspective over the last few years, where you've had to go back out and convince clients of the role for bonds in the portfolio and remake that pitch to them, and whether there is sort of a persistent, maybe something that will last a while, skepticism. Okay, you don't get the same insurance effect. Meanwhile, yes, you get coupon payment, but when you look at the insane returns that people are getting in tech stocks, you're like, well, what's this little 5% return getting for me? And so I'm curious whether the sales pitch or the client pitch has changed at all over time because of the experience of the last few years.
It has. Now, we focus on value versus passive alternatives. So our pitch is, invest with Pimco. We're going to provide you with a better experience relative to what you can get in passive portfolio alternatives. So we think over time, if we can do that, clients will come. And it was hard coming out of the GFC when interest rates were near zero, where policy rates were at zero or below zero for many, many years. It really planted the seeds for major change within the fixed income industry. And then you had the inflation, and then you had the very violent sell-off in 2022, where not only did bonds not insure much of anything, they themselves went down a lot.
Yeah, the mark-to-market on those were insane at the time. I remember doing a headline that was like, this was for corporate bonds, but it was like, demonstrational portfolio of IG bonds, and it was down like 30% at that period. Anyone holding fixed income, especially as a retirement option, would have been massively hit.
Absolutely correct. And in some sense, it was a prerequisite to get value back in fixed income markets. But if you go back several years, because rates were near zero or outright negative in major parts of the developed world, people were forced to look for alternatives. And what you've seen over that period is massive growth in floating rate, lower quality corporate credit. That's very unusual when you go back several decades. And historically, floating rate, lower quality corporate credit is quite dangerous because when you have an economic shock, short rates go down, that floating rate, lower quality credit, just as it becomes more risky, sees its yield drop quite considerably, especially if policy rates or neutral rates are as low as some people may think.
You're getting paid less and the odds of default are going up.
That's correct.
Yeah.
And we have a dynamic now where you've seen the lower quality floating rate credit markets grow on the order of, a couple $1 trillion in size. And that was due to the fact that it was really the only game in town. There was no real attractive yield in high quality markets. Today there is. What do we know is coming up most likely in a few days is that these short rates are going to begin to go down again. So you have a really, really interesting dynamic in the market where people rushed into these floating rate sectors and segments of the market. Their yields are going down. You don't have the ability to lock in those longer real rates.
Yeah.
So we do think this could be a meaningful turning point. And I think, again, in looking at fixed income from the standpoint of a 30, 40, 50-year time horizon, it's really been the exception of the rule the last several years where you've had this dynamic in play where duration was a really, really bad thing and where you really needed to perhaps reach a little bit to maintain an attractive income in some of the more economically sensitive or riskier areas of the bond market. Now, if you have a hard landing, this dynamic can turn quite quickly back towards the old days. If you have a softer landing scenario, this dynamic will play out much more slowly, but it does create what could be the next wave of interest into fixed rate, longer maturities within the fixed income market.
Okay, so speaking of credit and floating rate loans, do you feel pressure or competition at all from, I guess, the proverbial growth of private credit, the booming private credit market? Is that something that either makes it harder for you guys to secure paper or maybe makes the yield on that paper a little bit lower? What does that mean for your business?
From an investment perspective, it's actually a really good thing. And in fact, even some of the growth of the ETF market has been positive. A lot of these rules-based strategies we see in the ETF space, the daily disclosure of activity within ETFs, has created frictions in certain more complex areas of the market that have led to the ability to more easily generate active alpha within our strategies. On the private credit side, it's a bit more nuanced. We are seeing more risk get transferred into private markets, which ironically has made the traditional high yield markets much more robust. I can't tell you how many times we look at credits within the high yield corporate bond space. We say, look, we're looking at these financials, maturities coming up. This company cannot afford to pay this coupon rate to refi their debt, only to find out a private credit manager has taken them out with a PIK deal. So instead of having to pay the full coupon interest currently, they have the option in the private credit markets to get a more aggressively structured transaction. We've seen this dynamic off and on throughout my time within the industry. And again, it is leading to some friction in markets, some opportunity as well. So, yes, if more and more risk gets transferred to the private markets over time, it will lead to a reduced opportunity set. But from an active investment management perspective, those types of frictions actually create opportunities to generate alpha versus passive alternatives.
So this is interesting. I just want to clarify, so from an abstract level, I certainly understand how market frictions are what create mispricing and therefore the opportunity to generate alpha. But when you talk about the private credit space creating these frictions, can you just sort of clarify that a little bit more, like what that looks like, or math it out for us or something?
Yes. So again, in looking at, first of all, some of the lower quality areas of the market, a lot of these pretty significant flows have impacted technicals across the credit sector more broadly. So analyzing and understanding the type of risk transfer going on in the private markets can really improve your ability to generate return, make good credit decisions within the traditional high yield or even the bank loan universe. I think that another big dynamic in private credit today relates to a lot of flows into insurance platforms. Insurance companies are regulated entities. They're mostly regulated based on rating. And this feels a little bit similar to even the years leading up to the global financial crisis, where there's increasing influence from rating agencies. Now, rating agencies try their best to rate risk and assess risk, but there's increasingly a gap between the type of structures necessary to put into certain vehicles that are a source of demand for private credit relative to our own views on the inherent credit quality of those particular instruments. And the fact that you're back now, even over the last few years, to so much capital optimization going on across these platforms that there is opportunity to do your own work, compare that work to ratings out there across both the public and the private credit space, and be able to make really, really good relative decisions versus those entities, those big players and growing players in the market that need a rating, that they need some type of structuring in order to optimize capital under a evolving regulatory framework. So those are the type of frictions that we talked about earlier that are good to have around. Because it does allow you to generate return in mandates that are less inherently constrained in that regard.
Since you mentioned regulatory framework, how closely are you following something like the Basel Endgame proposals? Because this is the forgotten event risk of this week is also we're supposed to get the unveiled Basel Endgame suggestions or proposal. And those include a lot of potentially new guidance for how banks hold things like MBS and treasuries and mark-to-market losses on things like that.
Yeah, so we follow what's going on with Basel rules. There's also a lot of work being done across various insurance regulators, even a lot of work going on across the regulatory regimes that impact various mutual funds and other positions here in the U.S. and over in Europe. So these are going to be important. Again, from the standpoint of good, well-functioning markets, we think that a lot of these regulatory regimes should be looked at. We think that a lot of the regulation that got put in place post-global financial crisis turned out to be perhaps a bit backward-looking, a bit aggressive, but all these types of regulations create these types of frictions that we look to exploit again in some of our more flexible active strategies. So they're going to impact what banks can do, what risk needs to get laid off. And we've seen increased activity even there too with these various SRT transactions and other aggressive transactions on the capital optimization side. But again, all this may not be so good for financial market efficiency, but these types of activities are very, very good from an active asset management perspective in order to come in and take advantage of these frictions for the end investor.
Are you involved at all in synthetic risk transfers? Is that something of interest to you?
We are. In fact, I was a trader of this space back when I first joined Pimco, back in the late 1990s. And we have a lot of folks here that have looked at.
Oh, this is like old school SRT if you're talking about the 1990s.
It is. And SRTs are similar in many respects. It's a different flavor, each time. And it's an interesting segment of the market. They're simple deals to some degree, but then there's a lot of complexity in terms of understanding waterfalls, how losses are allocated, the documentation details. So they tend to be popular in the sense that you look at it, the risk, and you say, hey, look, I could get a very, very attractive coupon. If I avoid, losses up to this point, I'll have a good investment outcome. But again, a lot of inherent complexity. So we've been involved for a long time. We've done a few deals recently. We think it's an interesting area of the market. But it's an area of the market where back a year and a half or so ago, when the regional banks were going through a lot of challenges, there was really good value for the end investor sourcing that risk. Today, with all of the money chasing some of these opportunities, some folks apparently or appearing to compete based on market share as opposed to prudent underwriting, there's times where some of these SRT deals are getting done at levels quite advantageous to the banks that are selling that risk. And not surprisingly, when you have that dynamic in play, you're going to see more and more of these transactions. So it requires a lot of nuance and some good value there, but there's pockets of froth even in that SRT market today.
That's interesting. By the way, listeners, if you're just tuning in, Tracy and I did an episode with Michael Shemy several weeks ago all about how SRTs work. So a good primer to go back to and check that out. I want to go back to the macro for a minute and sort of where we started and thinking about where we're going over the next several years. And we're in an era of very high deficits historically. You mentioned, there's talk about, all this like friendshoring talk and reorientation of supply chains. That's costly. Geopolitical tensions have risen. That's going to be costly on multiple fronts if it persists. And politics changes, obviously there was the sort of more comfort with fiscal expansion and things like that. And, in a way that we might not have expected years ago. All these things like, looking out a few years, how are you thinking about these changes that are coming or these risks and how they're going to change the flavor of markets over time?
Yes, a few points. One, interesting that we had a pretty extensive discussion today. We didn't talk about inflation too much.
Yeah.
And
tell us more. What's going to happen with inflation? That's yesterday's news. No, actually, we probably should.
But
tell us more.
But I bring that up only because we do think, to answer your question, over the next several years, even though inflation may come down from a cyclical perspective, it's likely here to stay. At least.
Then why do you think that we've only seen such a modest increase in the neutral rate if inflation here is now going to be sort of like structurally at least somewhat higher?
Well, we think inflation may be a little bit higher structurally, at least the base case. We think that the risks around inflation will likely be more symmetric. So again, you go back to the GFC and the years following the GFC, most of the challenge for central banks were to get inflation back up towards target.
Yeah, it kept missing on the downside.
And we think, over the next several years, for the reasons we talked about, inflation risks will be more symmetric, which creates opportunities for investors to source inflation protection across portfolios. We also think, to your point, there's going to be more geopolitical uncertainty. Deficits are high. Many countries, including the U.S., which jumps out as being a government that can't continue to run these types of deficits indefinitely. And we think because deficits are high, because market participants generally believe that central banks and fiscal agents had something to do with inflation this cycle, you're likely to have less policy activism on an ongoing basis. So this feels like, a market the next several years that will have to stand on its own merits more than it has in the past. Less influence from policymakers, more local volatility, less synchronized growth cycles, with the risk of meaningful geopolitical uncertainty as well.
A lower strike price on the Fed put, so to speak?
And probably a lower strike price on the put, but the power of the Fed may be less than it's been in the past because of this very, very challenging inflationary situation we were in after the very activist policies during the COVID period. So, I think it's premature to say that the Fed and other policymakers aren't going to be there during extreme bouts of volatility. There is a question, though, from our perspective as to whether they could be as impactful as they've been in the past. Again, good for active asset management, but there's a risk management reminder in there that you got to be a little bit more humble about the risks of overshooting, the risks of harder landing scenarios, the risk that, as fixed income investors, we're going to have to go it alone, so to speak, and not rely on central banks to bail out some of the underperforming areas of the market.
Tracy, it's interesting. When we had that volatility in early August, none of the Fed speakers played ball with the talk of emergency rate cuts or aggressive, because that was in there, and they did not, and they were very cautious, and they didn't really talk about the market volatility, and they said we're just going to see the data. It was very interesting how they were cool throughout the whole thing.
I know it was only 6 weeks ago, but I've already forgotten that whole period. But some people were calling for a 100 basis point emergency cut, right? Okay. When I think about event risk on the horizon, the return of inflation, the hard landing scenario, but also geopolitical risks, which you just brought up. And if I'm thinking back to the idea of bonds as a hedge, and I'm thinking about U.S. Treasuries, it feels like U.S. Treasuries aren't necessarily a good hedge for a particular flavor of U.S. political risk. How do you hedge for that type of volatility?
Well, one thing that we've done, and it's not just related to the election, is to maintain a lot of portfolio liquidity. Liquidity means flexibility. Liquidity is a form of positive optionality. If you have a volatility event associated with our election or some of these other geopolitical risks that are out there, markets can overshoot. And I think a key theme in generating return for an active asset manager is being there to counter trade the market if you do have overshooting. And I think that this election setup is one where it's a coin flip. And uncertainty is only increasing going into this election period. So we don't yet have conviction in terms of what's going to happen. We just want to have a bit more flexibility. That's point one. Second point, when you step back and look at the likelihood of generating attractive returns in the next few years, the U.S. is not the only game in town anymore. Rates were negative elsewhere in the world, outright negative, not even on an inflation-adjusted basis. And these markets have reawakened, particularly from the standpoint of a U.S. dollar-denominated investor. So you do have options versus the U.S. The Australian bond market, the U.K., both markets out-yield the United States. opportunities to diversify into other developed markets. Even Japan, on a hedge basis, has some interesting yields out in the long end of the yield curve. So, we have, over the course of the last several months, have been using the full breadth of the Pimco platform, the flexibility across a lot of our mandates to diversify a bit away from the U.S. And again, that theme will likely continue, where investors, to optimize their portfolio, should look outside the U.S. at both higher quality and lower quality markets out there in the world. And we do think some diversification away from U.S. higher quality interest rate exposure makes a lot of sense at this point in the cycle.
I'm going to ask a really ignorant question, and maybe you're just going to say, no, that's not a thing. Do you have a capacity to buy Chinese government bonds, which have done extremely well, and the long end of the curve has come way down there?
We do. And, do
you have exposure to that market?
We have very little exposure to their in they got, yields, in the 2% type zone, in the higher quality area of the market, but an example of less synchronized global growth cycles. Their growth slowing, no inflation problem. It, in theory, is a decent diversifier. I think the problem just in the market right now is a lot of that's priced into the Chinese market.
So the last time we spoke to you, I think it was August 2022, something like that.
Yeah.
And a lot of
turning points.
Yeah.
we turned to Dan.
Well, and a lot of the conversation was about the potential for a recession, a housing slowdown, things like that. And of course, fast forward to September of 2024, and corporate credit has held up phenomenally well. I take the point about disparities between, lesser quality and higher quality. The housing market has been pretty robust, more than a lot of people would have expected. Thinking back over the past couple of years, what have you learned from that experience, and how do you incorporate it into the Pimco investment strategy?
Well, this was a exceptionally unique cycle. We had a global pandemic, something none of us had witnessed in our lifetime. Sudden stop of the economy, massive policy response, and an inflationary environment that many of us didn't see in our actual trading career. The young folks at Pimco even less so. So I think it's just a reminder that the unexpected can happen. And it's important, again, to have appropriate humility from a portfolio construction perspective. Think about diversification carefully. Risk management's critically important, not just defensive risk management, but having a risk management mindset because you can go through these unique periods. And as we talked about earlier, when valuations are stretched, it doesn't necessarily take a global pandemic type shock to create some challenges and opportunities for the firm or the strategy that's well positioned. I think looking back on the last few years, a lot of this inflation likely will be perceived as being at least temporary or due to very, very unique COVID supply chain complications and this massive fiscal stimulus that occurred. But we got a lot to learn, a lot to analyze, and I think going forward, plenty of uncertainty as well. So, we try to be careful about being too overconfident. We get the behavioral finance folks always in our ears reminding us that people like myself tend to be prone to overconfidence unless we protect our clients from our own natural instincts. And again, just trying to learn, continue to read the economic history books, compare it to the current environment. Again, leveraging the team. Investing is a team sport, and you don't have to take wildly big macro bets to just generate lots of small return across a variety of sectors, parts of the globe. And again, if you do that well, it adds up into a good client experience at the end of the day.
All right, Dan Ivascyn, I'm so glad we could catch up with you in person on the West Coast. Thank you so much for coming back on Off.
Thank you so much, Dan. That was great.
Thanks a lot, guys.
Joe, that was fun.
That was really fun. What a treat to get to talk to Dan Ivascyn
right before Fed Day.
Yeah.
Also, I was thinking, can you imagine being in that room with Ben Bernanke and Richard Clarida?
Actually, when he said that, I had this it didn't quite register to me. He's like, "Oh, we have our advisor Ben Bernanke," and I was, it didn't. I was like, wait, what is he saying? And I was like, is he speaking metaphorically? It's like, no, but when you're Pimco, you can really hire Ben Bernanke on Fed Day to talk to you about what just happened.
Yeah, must be nice. Okay, well, there's a ton to pull out of that conversation. One of the things that struck me was very early on, he talked about the credit cycle and what's been going on there. And I guess the downsides of looking at aggregates, which is, even when you see credit spreads falling or staying very, very low in totality, it does conceal pockets of weakness and pain for the least quality names in there and parts of CRE and things like that. And I think that is worth remembering as we kind of talk about, well, the Fed's cutting rates and we haven't had that hard landing scenario that a lot of people thought would emerge. There are these pockets of weakness out there.
Totally. Which, of course, has contributed to why just so many people are confused about the economy, because you can sort of point to anything and tell the story you want. I also thought it was sort of interesting. And, I get like there's a lot of logic to it. This idea of like, okay, for a couple of years there, bonds did not play the role in people's portfolios that they might have gotten used to. And I really just think like by we, I just mean like investors, like people who put their money with other people or in some form. Like we just hit it so easy in the 2010s because like really it was just like this beautiful synergy of stocks and bonds, various flavors of 60-40, what have you. Like it all worked out and you like didn't lose money. And 2022 in particular was like a sharp reminder, and you like pointed to the stats like, no, like that paradigm like broke in a really big way. And so the question to my mind is still like, okay, even if inflation is like come down, we do see fixed income providing this sort of insurance hedging role that it did. Like, are people going to be like totally comfortable allocating that much to fixed income, especially because of kind of what we were talking about at the end there? There are these different macro dynamics, geopolitical dynamics, political dynamics that could change basically how bonds trade.
One day in the future, we'll tell our children that a successful investment portfolio was basically just 60-40.
Yeah,
and that was it. Yeah. That's how easy it was.
It was
and
so
now,
easy.
Now it's complicated.
We didn't know how good we had it.
But you're right. I do think the memories of that like very dramatic mark-to-market loss are going to stay with us for a while. But so it was interesting to hear Dan talk about this idea of like having to go out to clients and repitch bonds as a useful hedging instrument in your portfolio. And I wonder how quickly attitudes will adjust once again. I guess it depends on what happens this week and beyond.
We will see.
All right. Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our producers, Kerman Rodriguez at Kerman Armin, Dashiell Bennett, who is out here in Newport Beach with us, Cale Brooks at Cale Brooks. Thank you to our producer, Moses Andam. For more Odd Lots content, go to Bloomberg.com/oddlots, where we have transcripts, a blog, and a newsletter. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we talk to very large bond investors on the West Coast, then please leave us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, you can listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.